Welcome to the debate. So today we're looking at an industry that sits right at this really uncomfortable intersection of necessity and finance. It's a model that serves 4.8 million customers at any given moment. Yet it's frequently misunderstood, often maligned, and legally very complex. We're talking about rent to own.
It is a fascinating topic because it forces us to ask a very, very difficult question. What is the price of access? I mean, we're looking at a financial structure that spans everything from a sofa in a living room to literally the roof over your head.
Exactly. And the central question we're debating today is this. Is the rent-to-own transaction, often abbreviated as RTO, is it a vital lifeline that grants access to goods and property for the credit constraint? Or is it, as critics so often claim, a predatory loophole designed to disguise high-interest credit sales as simple leases?
I'll be taking the position that RTO is, it's structurally exploitative. My argument is that while it masquerades as a service, it really functions as a high-interest credit sale that bypasses the consumer protections we've built for lending. It effectively charges a premium for poverty.
And I'll be arguing that RTO is a legitimate, service-heavy lease that solves a problem traditional banking, frankly, refuses to touch. It offers flexibility, specifically the ability to walk away without debt, which is a unique economic utility that I think justifies the cost. And we aren't just talking about local furniture stores anymore. We are looking at a model with roots going back to Lotus Radio in the UK in 1933, and it's now exploding in emerging markets like South Africa, where revenues are projected to hit over $350 million by 2025.
Those growth figures are staggering, I admit, but let's look at what's actually fueling that engine. You mentioned flexibility as the core benefit.
I did, and to understand my position, you really have to look at the mechanics. The misunderstanding usually starts with the definition. People conflate RTO with hire purchase or a standard installment plan. In those traditional models, you are signing up for debt. You owe the money whether you keep the item or not. The defining feature of rent-to-own is that the consumer, the lessee, can terminate the agreement at any time.
At any time is a powerful marketing phrase.
Well, it's not just marketing, it's a legal reality. If you lose your job or if you simply decide you don't want the washing machine anymore, you return it, there's no penalty. There is no lingering debt on your credit report. And when the Federal Trade Commission surveyed customers back in 2000, this was the #1 reason they cited. They explicitly chose RTO for the lack of a credit check and for convenience. They understood they were paying for an option, not an obligation.
I don't dispute that the option exists. My concern is the cost of that option. You cite the FTC survey regarding convenience, but we have to look at the other side of that same data. The most common reason for dissatisfaction in that same survey was high prices. And this is where the service narrative starts to crumble for me.
How so?
Because if you look at the math, you're paying 3, sometimes 4 times the retail value of the item. If this were classified as a credit sale, it would be subject to the Truth in Lending Act. You'd have to disclose an APR, but because the industry lobbies to call it a lease, they avoid that disclosure entirely.
It's not just bobbing, though. It's the law in the vast majority of the country.
It's a contested law. We have to look at the judicial pushback. Courts in New Jersey, specifically in Perez v. Rent-A-Center, and in Minnesota with Miller v. Color Time, they looked at the economic reality, not just the contract header. And they ruled that these transactions are credit sales. They saw the lease label as a fiction, really, used to evade usury laws.
But you're cherry-picking the exceptions. As of 2011, 47 states in the District of Columbia have passed laws that specifically characterize these transactions as leases. State Supreme Courts in Massachusetts, Arkansas, and Maine have all upheld the lease definition. The legal consensus is overwhelmingly on the side that this is a unique transaction type, not a loan in disguise.
Legal consensus can often lag behind economic justice. I mean, even the Department of Defense back in 2006 initially labeled RTO a predatory lending practice right alongside payday loans. They recognize that for a young soldier or any consumer living paycheck to paycheck, paying $30 a week for 100 weeks for a laptop, that's a trap.
I do have to correct the record there. The DoD excluded RTO from that regulation the very next year in 2007, after the Government Accountability Office raised some serious concerns about their methodology. But let's move from the legal definition to the actual economics on the ground. I want to talk about consumer goods.
Let's dig into it. because that weekly payment is where the rubber meets the road.
The narrative you're painting is that the consumer is being tricked. But this model was built by pioneers like Charles Loudermilk Sr. of Aaron Rents and J. Ernest Halley. Their goal wasn't to trick people. It was to move inventory, originally Army surplus chairs, to people who couldn't afford to buy them outright. The price you see on the sticker includes much more than just the hardware.
You mean the service argument?
It is a service-heavy model. Delivery is included, assembly is included. But most importantly, repair and maintenance are included.
Walk me through why that justifies a 300% markup.
Well, think about the alternative for a low-income family. If I buy a washer on a credit card, assuming I can even get one, and it breaks 2 months later, I'm in a bind. I still owe the credit card company the full balance plus interest. And now I have to find $200 for our repairman. In an RTO agreement, if the washer breaks, the store fixes it or replaces it immediately. That maintenance cost is factored into the weekly payment. You aren't just renting the metal and wires, you're renting the guarantee of a working machine.
That is a compelling argument on the surface. It sounds a bit like insurance. But have you considered the poverty penalty?
Meaning the general higher costs of living for the poor?
Precisely. Academic researchers and consumer advocates have long pointed out that while you cite services to justify the cost, the premium paid is it's disproportionate. We're talking about individuals who can least afford additional financial outlays. When you do the math, paying $30 a week for a television that retails for $500, by the time you own it, you've paid $1,500. The service of a potential repair doesn't bridge that $1,000 gap. That's wealth extraction.
But you're assuming they keep it for the full term. The data shows many don't. They return it. They use it for a specific need, maybe a temporary living situation or a short-term job, and then they hand it back. For them, it was a cheap rental, not an expensive purchase.
But maybe intend to keep it. That's the dream being sold. Own it in 12 months. And for those who do, they're often unaware of the high long-term costs compared to, say, layaway or traditional installment plans. And we have to talk about the pressure at the end of the term.
What pressure?
There have been allegations that stores routinely repossess merchandise right before ownership is acquired. Imagine paying for 18 months, missing that final payment, and losing the entire item.
I have to stop you there because that is a persistent myth that the data simply doesn't support. The FTC found a low incidence of late-term repossessions. And why? Because most states mandate reinstatement rights. If you miss a payment and the item is taken back, you have the right to pay the arrears and get the item or a substitute of equal value back with your equity intact. The industry wants the customer to succeed. A repossession is a loss for the store, too. They have to clean it, repair it, and try to rent it again as used stock.
I'm not convinced that the store's incentives are purely benevolent. Even if repossession is rare, the threat of it drives the payment behavior. It keeps the consumer on the hook in a high-cost ecosystem. The fear of losing the item is what prioritizes that payment over, say, a utility bill.
But that payment priority is the consumer's choice. They value the item.
Or they value the sunk cost. But I will admit, the consumer goods sector is where the model is most established and regulated. Where I think the risks become truly existential is when we move to our second topic, real estate.
I agree. The stakes are significantly higher in housing. RTO in real estate tends to become popular during economic downturns, like the 2008 financial crisis. When credit tightens, this becomes the only game in town for some people.
Which makes it predatory by design, doesn't it? When subprime borrowers can't get loans, they turn to these lease purchase agreements out of, frankly, desperation.
Or out of opportunity. For many, it is the only path to homeownership. Here's the utility. You have a tenant buyer with imperfect credit. They find a house, they sign a contract that locks in a purchase price, a market rate for 1 to 3 years. They move in immediately, and they live in the home while they repair their financial profile. It freezes the market for them.
But look at the structure of the payments. It's not just rent.
No, the structure is actually quite brilliant if it's used correctly. You pay market rent plus an additional amount called a rent credit. This extra money goes into an escrow account. It acts as a kind of forced savings. At the end of the lease, that accumulated credit becomes your down payment. It solves the two biggest hurdles simultaneously: credit score and the cash for a down payment.
That is the brochure pitch, but I view it differently. The New York Times referred to this not as a purchase option, but as the maybe option.
Why maybe?
Because the purchase is contingent on the tenant securing a mortgage at the end of the term. If after 3 years the bank still says no, maybe your credit didn't improve enough or lending standards tightened again, you don't just lose the house. In many contracts, you forfeit the deposit and all that accrued rent credit. You walk away with nothing.
That is the risk of the contract, yes. But compare that to the alternative. Renting a standard apartment for 3 years, you walk away with nothing there, too. At least here, you had a shot at equity.
But in a standard rental, you aren't paying a premium above market rate for a credit you might never see again. If I pay an extra $300 a month for 3 years, that's over $10,000. If the deal falls through, that money is gone. That's not renting, that's a failed investment.
It is a risk, I grant you, but the industry would argue that the tenant had exclusive rights of the property during that time. That option has value.
The vulnerability is that these are, to quote the source material, flexible open source agreements. There's no standard form. This leaves massive room for scams. Unprepared tenants can be taken advantage of by landlords who know the tenant will likely fail to get financing. They just collect the higher rent, keep the deposit when the deal falls through, and then rinse and repeat with the next hopeful family. It becomes a churning model.
I acknowledge that scams exist and bad actors exploit the lack of standardization. But simply saying it can be abused doesn't mean the mechanism itself is flawed. It just means we need better frameworks. And this actually leads perfectly into our third topic. The industry isn't standing still. There's recent academic work from 2025, specifically the Nest Quest RTO models by Mohammed Billah, that attempts to solve exactly this ambiguity.
Right. I have reviewed the Billah work. It is certainly ambitious. But does adding more complexity actually help the consumer?
It's not about complexity, it's about transparency. Billah proposes a formal mathematical structure to sort of sanitize the industry. The Nest Quest RTO model uses what he calls a tripartite ledger.
Okay, break that down. Tripartite ledger sounds like something that requires a PhD to audit.
It's actually very intuitive. Instead of a vague contract where your money just disappears into a landlord's pocket, every payment is mathematically divided into 3 buckets: consumption, which is the rent; equity accrual, which is purchasing fractional ownership; and operating costs. It creates a completely transparent view. The tenant knows exactly how much of the house they own at any given second. It even includes rules for hardship pauses and exit settlements, so you don't just lose everything if you have to walk away.
I will grant you that defined rules are better than the Wild West of open source contracts. If a tenant can see their equity growing, that is an improvement. But my concern with the NestQuest models, and specifically the RTO plus Gold model, is that it seems to be solving a problem for the investor, not the tenant.
Complexity can be a shield for both parties, though. The RTO plus Gold model is fascinating. It pairs the home occupancy with a systematic reinvestment. The sponsor, the one funding the house, reinvest their cash flows into a digital gold savings account, or DGSA.
And this is where my alarm bells ring. We're taking a population that struggles with basic credit access. People who are perhaps unbanked or underbanked. We're introducing a dual ledger system recording balances in local currency and gold gram units. It feels like financial engineering run amok.
It's an inflation hedge. Think about the landlord's risk. If they lock in a price today and inflation spikes over the next 3 years, they lose money on the deal. The DGSA links account values to independently verified gold prices. It protects the reserve. In an economy where cash loses value, having the underlying asset backed by gold index savings ensures that the whole system is resilient.
But who is that resilience for? The sponsor or the tenant? The source material says the sponsor accumulates this inflation-resilient reserve. I worry that we are turning a housing transaction into a sophisticated investment vehicle for the capital provider, while the tenant is just trying to keep a roof over their head.
The tenant gains equity, though. That is the key. The model is designed so the occupant acquires the real property. The gold component just ensures that the provider of the housing can afford to keep offering the service without going broke from inflation. If the business model isn't sustainable for the sponsor, the access disappears for the tenant. It's a symbiotic protection.
That's a fair point on sustainability. If the landlords go broke, the housing supply vanishes. But does the math ultimately lower the cost of ownership? Or does it just track the high cost more accurately? Explicit formulas and deterministic ledger rules are great for researchers, but if the end result is still that the poor pay a significant premium for housing compared to the wealthy, the fundamental inequality remains?
I would argue that transparency is a form of cost reduction. If you know exactly where your money is going into equity versus consumption, you can make better decisions. The tripartite ledger prevents the landlord from hiding junk fees. It creates a fair playing field, even if the cost of capital is higher due to the inherent risk of the borrower.
I suppose we'll have to see if these models gain traction outside of academic papers. For now, the reality on the ground remains the traditional, often murky, RTO contract.
Which brings us to the conclusion of our debate. We've covered a lot of ground, from the appliance showroom to the housing market and into these theoretical gold-backed ledgers.
Indeed, and I think my position remains firm. While I appreciate the theoretical improvements and the service arguments, the rent-to-own model as it exists today is structurally expensive. It charges a premium for poverty. Whether it's a furniture lease in New Jersey or a housing contract, the user bears a disproportionate amount of risk. The judicial dissents in states like New Jersey and Minnesota aren't just legal technicalities. They're warning signs that this lease often functions as a high-interest loan without the safeguards.
Yeah, I see why you think that. And look, the cost is undeniable. But let me just leave you with this perspective. The rent-to-own industry fills a void that traditional finance refuses to touch. 4.8 million people use this service. 47 states have validated the lease structure. So whether it's the historic growth of APRO members or these new frameworks like NestQuest, the industry is providing access to appliances, computers, and homes today. Not someday when credit improves, but today. And for a family that needs a refrigerator to store food or a roof to sleep under, that access, it's worth the premium.
That is the tragedy and the utility of it, isn't it? It's the only option for many.
It is, and barring a complete overhaul of the banking system, it will likely remain the primary option for the credit constrained.
And that is why this debate matters. As this market grows, projected to reach over $350 million in South Africa alone, understanding the fine print is vital. Whether you're signing a simple one-page lease for a sofa or entering into a complex RTO plus gold agreement for a home, you need to know if you're building equity or just renting time.
We encourage our listeners to look at the mathematical models and the legal history themselves. The distinction between a lease and a sale might seem like semantics, but it determines your rights and, ultimately, your financial future.
Absolutely. Intellectual charity requires us to see the utility, but critical thinking requires us to check the price tag.
Thank you for joining us on The Debate.
Until next time.